Good morning. You're watching the market right here on ET Now, and coming out of another volatile week, we closed sub the 17K mark on Friday's session. 16,955 thereabouts was the print where we shut shop, and once again it was the global factors bogging us down. This week, while of course it's a truncated one, you've also got the financial year closing, remember, on March 31st. You've got a FIIs expiry as well this week, and D Street is also going to see the effect of grandfathering in debt funds, that also getting absorbed. So lots on our plate, even though we've got just 4 trading days to cope with.
It's just one of those weeks where you may not be resigned to a particular event per se. There would be a push and a pull element. Year-end ending, which could have impact on some NAVs or window dressing. B, you got an FNO expiry in a truncated week. So you put all these things together, you may not see too much of market movement based on news per se. But yeah, the markets have been volatile to say the least. You getting support at closer to 17,000, but 17,200, 17,300, this market is running into a resistance. I don't think this market is nervous, but this market clearly is not excited. Globally, one thing is evident, that the challenges in the US financial sector that clearly have not snowballed into some kind of a downward spiral. So that's a relief on that front. B, the print, at least on commodity, and the US macro data seems to be indicating that worst of the inflation is behind us. That is also a relief. But locally, I don't think the markets per se are really excited about something really big to look forward to. It's too early to say that for individual stocks the bottoming process has started, but a lot of brokerages, we'll talk about it, have come out and they've raised a green flag or a yellow flag, saying that now it's time to examine the market closely, because markets are nearing what could be called as a valuation bottom. That's the word. Are you nearing a valuation bottom, or are you still a distance away from the valuation bottom? That's the only thing that matters.
But the FIIs selling still hasn't abated.
And I don't think it'll abate in any kind of a hurry, because there are a lot of compulsions which clearly are at play. You got hit because FIIs were selling as they were getting a market like India. 2022 FIIs were selling because they were booking profits. 2023 they were selling because money was moving out of India to China, and currently there are these bond losses which in a sense are forcing foreign institutional investors to really hunker down their outlook towards emerging market. So there is a lot of compulsion which is at play, which is in a sense forcing foreign institutional investors to sell. Why do you sell? You sell because you think that markets are expensive, which Indian markets are not, or you got redemption, or you need to do risk management. I think the latter is at play. The whole narrative that India is expensive, I think, is over. India was expensive. Now there are technical compulsions which are at play, and it's anyone's guess that how long the technical compulsions would be at play. But my limited point is that you're nearing that moment in the market, or that turn in the market, where the downside purely based on valuation is limited. If you have bought stocks at these levels historically, the chances of making money are far higher than chances of losing money. Similarly, last October, December, if you bought into stocks, the valuations were so stretched that the historical averages are indicating that you need to be either a seller or you need to book profits. Now, whether it's a 5% decline or a 10% decline, that's the risk appetite, but directionally you want to be a buyer. If you're sitting on cash, start putting money to cash. I'll stick my neck out and say that the risk reward ratio now, the beam balance, is now tilting towards reward rather than risk.
That's exactly the word. Most of the brokerages are also saying that the risk reward is looking much better than what it was earlier. Because remember, India was trading at a huge premium earlier. That has narrowed down considerably, and that's the word coming in from Citi, Surinder Goyal as well. He's saying that the valuation has now become reasonable. Even Amish Shah of BofA has said that buying on dips is perhaps the best strategy at this point of time. And they're looking at buying Nifty at 16,000. We are almost 1,000 point away from there. So not anywhere close, but still, that's the word coming in from BofA. CLSA also also believes that the bearish indicator was 91%, which means that it's a good entry point at current point. And even JP Morgan is saying that the Nifty's headline PE is now back at 2018-2019 levels. So the so the premium that was there to the S&P and the EMs, that has contracted substantially, and that seems to be what working in the favor. So Nikunj, risk reward is something that you pointed out is already turning a tad bit better, but there are now downgrades, etc. also coming. For instance, this morning there was on M&M, and stock specific, it's becoming a lot more difficult to find those narratives as well. Do you think it's going to be a lot more difficult in 2024 to make money versus 2020, despite valuation at the index level being cheaper? Stock level, it's going to be more difficult?
Nisha, the way I look at the market is that I think that the second half for this year will be dramatically different than the first half of this year. And a lot will actually start settling down towards the second half of this year. We will pretty much get a sense where inflation is headed. We pretty much would get a sense that, how central bankers in a sense have really, what kind of approach they really would be having. The base effect of low commodity prices, I think, will start kicking down. A lot of commodity producers which have had a terrible patch, so to speak, because of high commodity prices, I think that also eventually will be behind us. Another 6 months, this market suddenly will start looking attractive, largely because then we will start talking about FY25. We've not had any returns in last 18 months. Another 3-4 months of no return, that automatically will make the market look attractive. Now, when it comes to individual stocks, we'll talk about the themes which would be at play. But in general, I think the second half of this year should be much better than the first half of this year. I think this market reminds me of what we saw in 2013-14, where the market gave you 2 years of no return. It was largely because of global taper tantrum. It was largely because of flows which got adjusted. But when you emerged out of that so-called, months of consolidation volatility, there was a ranked outperformance which was there in mid and small cap stocks. And India outperformance, I think, was visible. I can see traces of what I saw in 2013 and 14, where you will see a lot of underperformance, not because of local factors, but because of global factors. You would enter into a no return patch of 15 to about 18 months. 18 months already done. Another 3 months, you add back 2 more quarters of earnings, and suddenly you would say, FY25 market sasta ho gaya. Which means that markets will start preempting FY25 in the second half of this year. Now, whether that starts in August or September, I don't know. But my case is that second half of this year will be better than the first half of this year.